it would essentially go to $2 million. Okay, that's where Bitcoin would go. Because let's run through that math. I'm going to steal a tweet from a good young trader, I think, that the synopsis is, we are all trading derivatives of the United States federal fund rate. And when you think about that, it makes a ton of sense because the USA Fed funds rate basically sets the discount rate for the world, okay? Everything trades off of the US discount rate, which sets the US 10-year rate, which sets discount rates for global bonds. It sets discount rates for global equities. It'll set a certain level. It'll have some impacts on credit default swap spreads. So it was quite an astute commentary. And so on that, I think we have to evaluate what I view the Fed latest announcement. So 2 days ago, Wednesday, Jerome Powell came out and raised rates to by 75 basis points to 2.25 for a range of 2.25 to 2.5%. Fed funds are overnight. The market reacted positively. I actually thought that this was the first level of his pivot. Now, it's not a pure pivot, but I believe he has introduced some language called, which is, for example, the Fed is now at neutral. Okay. How can you be at neutral when inflation is 9% and Fed funds is 2.5%? I find that absolutely ridiculous, but they introduced this word. I don't even think they get to 3%. That's my personal opinion. But even if they only do get to 3%, it's a form of a pivot, in my opinion. And that's why you saw risk markets rally very hard. Now you'll get the other side of the coin. You'll get people that are saying, my God, he was so hawkish. I think he's a horrible poker player. Okay. He was up on the podium. His cards were shaking. He looked to me like he's holding a pair of nines and he's trying to pretend he has a full house. Okay. And he just did not look. He says stuff like, we're going to crush inflation. Yeah, that's a good one. Like, you're shaking like a leaf. You're going to crush inflation and also send the global risk markets into the toilet. So there's no way that GDP can grow. All of these things are problems. These numbers are based, these are somewhat dated and they haven't gotten better. So I'm throwing out numbers that are absolutely putrid and they actually have gotten worse, but they haven't been updated. So I always look at things on a macro basis, and I'm a debt guy. So I like to evaluate things on what's called enterprise value. A lot of people always look at market cap. They forget about the prior ranking debt. Well, that's the wrong way to look at stuff. If you have a prior claim in front of you, don't look at market cap. You better look at debt. So total global debt is 4 times total global GDP. 4 times is the equivalent of a company that has an enterprise value that's trading extremely rich to its sales price. If you want to look at, so GDP is global sales, total debt is one portion of enterprise value. In that scenario, all paths lead to Bitcoin. It's another form of debasing of the currency. And you don't want to be a bondholder there. Now, I've covered my bond shorts, okay? I am not advocating shorting bonds here, but I'm certainly not advocating being a long bond holder over a bond holder over the long term. You want to trade bonds, you think you're an absolute star, you might be picking up nickels in front of a steamroller as far as I'm concerned, but go ahead, knock yourself out. It's just a horrible investment, long term. There will always be unhappy unit holders. Having managed money, it's a horrible job, okay? Why? Well, if somebody puts money with you and you do really well, they were really smart to put money with you, okay? Had nothing to do with you. It's how smart they were to put money with you, right? And then if they put money with you and you crap the bed, even if markets, you've outperformed your benchmark, you're down, but hey, I'm presenting you with a return of minus 15%, but the benchmark was minus 22. So look at me, I'm such a star. They look at you like, how are you a star? You lost me 15%. You're the idiot, not me for putting money with you. You're the idiot. So, it's a bit of a asymmetric reward position to sit in that chair. Well, stop your belly aching then. Focus on the fact that over time, I believe Bitcoin will be embraced as in the words of an asset manager, a non-correlated asset that will provide diversification benefits, which is to say, you can reduce the risk of your overall portfolio and maintain the same level of expected return. Or the flip side is you can keep the same level of risk in your portfolio and enhance your expected level of return because of an asset like Bitcoin. You're there. You're seeing the apps that are being built on top of the Bitcoin blockchain. I mean, these user adoption numbers are absolutely astounding. And it's a combination of a technology and a store of value that over time will disintermediate the Visas of the world, that'll disintermediate a lot of the traditional finance management, traditional finance payment rails. This is something that you cannot afford to have a zero exposure to Bitcoin. The risk of having a zero exposure far outweighs the risk of having a 5% exposure that can have asymmetric returns that are non-correlated to other risk assets. What is a default? Well, it's debt relief, because basically then you have to restructure the debt, and the chances are you cut your debt in half or more. The reality is, though, that would be absolutely, in my opinion, so cataclysmic and so disruptive to the functioning of the fiat system. Everything would stop, okay? It would make the great financial crisis look like a walk in the park. Like, you talking about the potential default of even a G7 country, let alone the most important country of the world, the USA. I can't even fathom the grinding to a halt of the financial system, measured by things like OIS over LIBOR, the LIBOR OIS spread, which in the great financial crisis blew out to, you call it 4%. It's a measure of the stresses in the banking system. Well, 4% would probably go to 10%, which means any bank loan would be priced at 10% plus whatever they're charging you for your credit risk. At the end of the day, do things work at a 10% interest rate when right now we can't even make the government or the global debt markets work at a 3%? All paths lead to Bitcoin, in my opinion. It's either financial calamity, which I think a lot of Bitcoiners actually want. I don't want financial calamity. I can promise you my children don't want financial calamity, because the pain and the social unrest would be far outweigh the potential benefits to, Bitcoin is now the global reserve asset. Look, we can get to global reserve asset status without having to go through some sort of Armageddon scenario. And that's what I believe is going to happen. But the reality is, in order to survive a civil war, potentially, you have to just keep the people happy. They're not happy with inflation, but the alternative is, again, will you be happy when there's there's war in the streets? I don't think so. So let's hope that we can solve this with a slow bleed in the traditional finance system, and people learn that Bitcoin is their escape, is their lifeboat. Very simply, use fiat money as your checking account. Use Bitcoin as your store of value savings account. But fiat money is not good for saving. And that's where Bitcoin comes in. So it would essentially go to $2 million, okay? That's where Bitcoin would go, because let's run through that math. That, incidentally, is my price target, okay? It's not my limit. It's my price target in US dollars for Bitcoin. And it's based on today's dollars. There's your $2 million price target, okay? In today's dollars. Now, don't get mad with me, all you Bitcoin maxis. Why am I so bearish? Okay, it's a target. It's not a limit. And it has to go through my price target before it goes through your price target, which is, some guys are like, 10 times my price target. It's all possible. But here's the crazy thing. Right now, based on its potential, Bitcoin is such a rounding error that you have to have exposure to it. So if Bitcoin price target, my price target is 2 million, and I'm looking at your block clock right behind you, and I'm assuming it's right, the market is basically telling me that there's a 1% chance I'm right. Okay, 20,000 divided by 2 million. 1%. And I'm not 100% certain I'm right, Stephan, but I'm way higher than 1%. Like, you fargan ice holes, you gotta do the math. This is the best asymmetric return I have ever seen in my life. And you don't care if you get in and you move the price from 20 to 40, at least you're in. Because then at 40, it still has 50 times, 50 multiples upside, which means it's a 2% chance now. You moved it from a 1% to a 2% chance the market is telling you you're right. I think I'm like 70% chance that it's going there. So if I'm a big fund and I've done the math, I'm like, yeah, I'm going to move the market, but guess what? It's a rounding error. I got to get in. It's the price of admission.